Good afternoon, everybody, and welcome to the third webinar for 2021. And really pleased to have such a good turnout again today. My name is Jeff Stangl, and I chair CFA Society New Zealand. And today's topic, as I think all would recognize, certainly the CFA charter holders, is on ethics. In fact, the ethical obligations of institutional investors. And as we all know, ethics runs at the heart, the very core of everything that the CFA Institute and CFA charter holders sign up for. What we stand for is who we are as a professional organization, grounded by the highest of ethical standards. So it's really fantastic today to be offering you this workshop. And we're really excited to have Guy Elliffe, who is a CFA, of course, and corporate governance manager at ACC. Who will be leading today's discussion. And I'm sure Guy would be known by name, at least to a lot of you, as someone who's really stood out and has a very high profile in the corporate governance ethics sort of realm. So with that, let me thank you, Guy, for being a part of this today, and very much appreciate your joining us, and look forward to everything you have to say. Guy, over to you.
Brilliant. Thanks for the introduction, Jeff, and I also thanks for all the members and allied groups that have called in. Getting my CFA was certainly a pretty important part of my career, so it's nice to be able to give back a little and participate in the seminar. I'll just cover my background really briefly. I was an institutional equity portfolio manager for about 45 years, both in New Zealand and in the US, about roughly 50-50 in terms of time. And then came back to New Zealand, and after heading up AMP's New Zealand equity business, I joined ACC about 5 years ago as corporate governance manager, which effectively means I look after the relationships between ACC as an investor and the companies, the issuers we invest in. Just a couple of small print items to cover at the beginning. As well as being an employee of ACC, I'm also a director of the NZX subsidiary SmartShares, and should be aware of any conflicts that might arise from that. And secondly, this is the first time that I've really put together a presentation like this, so it's very much a work in progress. It's from my point of view, definitely Chatham House rules. I'm throwing some ideas around, starting a discussion, and certainly not making any representations of policy of either ACC or NZX, just purely a personal view. And lastly, having said that, I'm very interested in any feedback from any of the listeners or people who listen to the webcast on record, because this is all material I care pretty deeply about, and I'm pretty interested in developing it into something that's a little bit more robust than it is at the moment. So I look forward to any feedback, either by email or questions that maybe we can address at the end of this session. So moving on to the presentation, I've got to get the technology right. Cool. So we're on to the outline. So I'm going to talk a little bit about corporate governance, what it is, and then a little bit about ethics. And then we're going to talk a little bit about ethics in society, especially in relationship with some of the recent changes to the CFA ethics documentation. Then I've got 4 topics that I'm going to talk about that hopefully move from the theoretical into the little bit more of the pragmatic, and after that just a little bit of summary. Because although when I started this I intended to be relatively neutral, it did end up being a bit of a selling case for corporate governance. So it's sort of so obvious through the presentation I couldn't really avoid that. So I was sort of tied up in that aspect towards the end of the presentation. Inevitably, the subject matter I'm exploring is a bit sensitive. You know, it's just not possible to talk about right and wrong and values and behaviour and duties without causing some controversy. In that sense, I've tried to avoid specific examples that apply to outside parties. Perhaps we can address some of those in the Q&A, but in the context of the actual presentation itself, I've sort of mainly kept the theoretical. So my aim is very much to set out concepts and raise questions. I'm not trying to give advice here or make judgments myself. I'm really just trying to provide the framework to allow others to do that. I guess lastly, I sort of reflect on a Greenspan quote, which I hope is relevant. He said at the beginning of one of his presentations, "If I seem unduly clear to you, you must have misunderstood what I said." And I'm very much in that context, that very much throwing around some ideas and hopefully not being too prescriptive. Cool. So moving on to corporate governance. You know, what is it? If you look at the OECD, their definition is a system by which business corporations are directed and controlled. That's a little bit too broad for my purposes today. And I really like something that the NZ Treasury came up with in the mixed ownership model work that it did a number of years ago now, where it said the critical role of governance is to provide suppliers of funds to the organisation with sufficient confidence that the management of the organisation is consistent with their interests, so that they are willing to go on providing funding for the organisation. And just summarising that a little bit, which is sort of my working definition for today, corporate governance is a set of contractual relationships which provide investors the confidence to commit capital. So I guess that the definition as I've ended up with it does raise some interesting questions. Critically, if corporate governance is a contract between investors and issuers, how do investors represent themselves in that contract? And there's three levels of that as I see it. One is the structural level, which is sort of around regulation, effectively New Zealand laws, the NZX list of rules and the NZX code. And I think there's a very strong role for institutional investors to be involved in the process of setting up those structural components to regulation. Secondly, there's a lot of work at the issuer level. I guess at the document level, in terms of governance documents, constitutions, charters, and the likes, and then I guess a little bit more at the coal face. When there's an IPO of a company, it's the only real chance that investors have to define the terms of the governance relationship. So I see that as a very important time for IIs, as I'll refer to them, to make a contribution. And thirdly, there's an ethical level where I think there's times where there's a difference between how IIs behave and the ethical obligations under the documentation. So I think there's three strong levels. And given that any party to an economic contract is going to represent their interests strongly, I think there's a strong ethical obligation of institutional investors to represent the interests of our investors in this negotiation of this contract. I thought I'd just point out at this point too that I'm making no judgment here about how investors, and particularly institutional investors, are meeting these obligations. In a lot of cases they're met and some they're not, but I've avoided that part of the equation, if you like. If people have got questions at the end, I'm happy to address them, but I'm very much just trying to define what the obligations are and talk a little bit about how they're met. So that's the corporate governance side. So moving on to the ethical side, looking at the CFA definition of ethics, it's a set of moral principles or rules of conduct that provide guidance for our behaviour when it affects others. And I am deliberately, very narrowly looking at how those ethical obligations affect IIs in a pretty narrow scope. I guess there's really two ranges of thoughts or areas that I'm looking at. One is how portfolios are managed, how transactions are made. So there's a set of issues around that. And the issue I'll address first is the issues around the exercise of corporate governance rights and duties. These are pretty big topics, and I'm a little concerned that my presentation's a little ephemeral, but I tried, but I couldn't really get away from that. There's a couple of issues I'm consciously not covering. The first is the fiduciary obligation of IIs to their investors. I think that's well covered in the documentation, and I had to reduce the size of what I talked about. And secondly, as everyone knows, institutional investors do a lot of work to directly influence issuers, and working with management, talking to boards, and in the really cutting edge, taking a role as an activist investor. And I've deliberately ignored those aspects of governance as well. Lastly, I'm purely concentrating on the obligations to institutional investors, and I'm not addressing the implications for issuers, their advisors or directors. So this is a presentation very concentrated on institutional investors.
I might just jump in if I might. We have a question and a request. The question is from Krishna Reddy on questioning what about stakeholders who do not have contractual.
I think one of the topics I'm talking about is something called stakeholderism, and what I'm calling stakeholderism. So I think that probably addresses the question about other stakeholders pretty directly at that point in time. Cool. So this is the guts of the presentation, which I'll address now. And it could really be the whole presentation, but I'm going to try and cover this relatively quickly. So apologies if it's a bit rushed. So if we look at the CFA Institute and what it says about ethics, it appears in two places in the handbook. One is a mission to lead the investment profession globally by promoting the highest standards of ethics education and professional excellence for the ultimate benefit of society. And maybe a little bit of stress on those last four words. And then in the last handbook, there was a change that was made. It originally said to promote the integrity of and uphold the rules governing capital markets. And that has been changed to promote the integrity and viability of the global capital markets for the ultimate benefit of society. So there's been clearly a move from a narrower to a wider degree of accountability by institutional investors, and that's obvious in a number of other bodies, publications, and just picking out one, which is perhaps the widest I've found, is the United Nations PRI aims to enable managers by encouraging investments that contribute to prosperous and inclusive societies for future generations. So life's become a lot more complex for institutional investors, there's obvious questions there. What is benefits to society? What is societal utility? How is that measured? I think to be able to talk about that in context, I've got to talk a little bit about the global environment, that's what I'm going to do now, to hopefully set a context. I don't think it's an exaggeration to say that there's an emerging crisis of confidence in parts of society, especially in the US, about the financial system, in particular the performance of issuers and the performance of capital markets, and specifically for our purposes, the performance of IIs. The concept of a social contract central here. That is that there's the recognition that we have a financial structure which gives us the ability to form corporations, operate markets, operate as money managers, and that ability to do that is a contract which is provided by society and in some sense is almost a privilege. That structure will remain in place as long as society thinks that structure is working. And if the collective view is that it isn't working, that social contract is threatened. To say that the social contract is under threat is probably a long bow to draw, but I also think to be complacent about the risk is also ill-judged. I think that's pretty obvious by some of the risks that we've seen in overseas markets. And just to cover those, pretty quickly, I don't know how much attention the listeners have paid to the US presidential election, but some of those were quite far-reaching in their impacts on corporate governance. For example, one proposal was to issue 2% of stock per annum from shareholders to workers until workers own 20%, and another was to give workers seats on boards until 45% of the directors on boards were elected by employees. So I think it's fair to say there's a lot of societal interest in the corporate governance equation. More than that, I think IIs are under attack from both political discourse, from the media and from academia. And again, in the interest of time, I'll just list a few things. IIs effectively control 70% of the top 1,000 US companies. So the view is that they should be responsible for corporate outcomes. There's a view that collectively IIs have too much power. There's a view that the short-termism of IIs is destroying economic value. There's a view that there's been an abrogation of corporate governance responsibilities by especially passive funds and ETFs, and that abrogation of responsibility is destroying value. There's a view that financial markets are incapable of pricing complex risk, and I guess specific reference there to the role of derivatives investors that financed the GFC housing boom before the GFC collapse. There's a view that the rules of the game are unfair, that we've ended up with an unfair distribution of assets and incomes. There's a view that there's an asymmetry of outcomes. Again, an example there is the taxpayers absorbed all the downside risks of banks, but their shareholders take all the upside. And more broadly, I guess, there's a view that institutional investors and banks finance issuers who are increasing costs on society, everything from pollution to carbon emitters. There's a pretty strong argument or challenge that's being made to institutional investors for the quality of our governments. Whether those concerns are robust or correct or not is time for another day. But I don't think there's any doubt that we're being held accountable. So that raises some pretty critical questions. Are institutional investors responsible in whole or part for corporate outcomes? Who was responsible for Enron, the collapse? Was it the managers? Was it the board? Or was it the institutional investors who elected the board? Are institutional investors responsible in whole or part for financial systemic risk? Are institutional investors responsible in whole or part for the social outcomes? Or are institutional investors responsible in whole or part for outcomes of the financial system? So before moving on, there's 2 points I want to make. One of them, there may be a big difference here between perception and reality. There is an argument that the reference to non-investment factors is more a change in description rather than adding responsibility to embed into IIs. The representation that IIs maximise short-term profits with little regard for other stakeholders and long-term values, there's a view that that's flawed and that II behaviour does not destroy value. And without just going into too much detail, any DCF approach is materially driven by sustainabilities of cash flows and cash flow growth. And societal risk is very much front of mind in the guise of regulatory risk. So it seems to me there's at least a reasonable argument that a lot of these things that are characterised as new obligations in terms of institutional investors are already part of the corporate governance framework. And secondly, I think a lot of these things are different in New Zealand. You know, we haven't had the same core governance outcomes that international investors have had. We think we've had better social outcomes. And I think New Zealand, well, I know New Zealand institutional investors own a much lower share of New Zealand issuers. So New Zealand institutional investors aren't so obviously responsible for the outcomes as in the US, where 70% of the votes register with the US institutions. So sorry, that was all a bit of a mouthful, but all to set a bit of a framework to look at the 4 examples that I've chosen. And two of those relate to the way that institutional investors exercise their duties, stakeholderism and the relationship between IIs and boards, and 2 relate to the way that IIs behave in markets, market conduct and capital raisings. And I will cover those over the next 25 minutes or so, 20 minutes or so. So in a way, this discussion is going to be pretty analogous to what I've already been through, and I'll cover it pretty quickly. You know, in terms of the way that issuers saw their responsibility to their shareholders, it was well summarised by Milton Friedman. The social responsibility of businesses to increase profits. I hope I'm answering the question that Jeff put through to me, but I don't think there's any doubt now that stakeholderism takes the issuer obligations to a larger variety of stakeholders, I guess particularly employees, customers, suppliers, society and the planet. So I think that life has become more complex for issuers as they've expanded the accountability to wider stakeholderism. When I did my introduction, I said I was going to be talking about institutional investors and how ethical issues affected them. So I guess the question is, why am I suddenly talking about issuers and stakeholderism of issuers? And the real reason for that is that stakeholderism is an integral part of what the corporate governance, corporate contract that I discussed earlier. And as I hope to discuss in the next couple of slides, I think it's an integral responsibility of institutional investors to be an active participant in the way that the general corporate contract's negotiated, and I guess specifically how this issue of stakeholderism is implemented. To be a bit more specific, I think there's conceptual battle in corporate governance between stakeholder primacy and stakeholderism. And if anybody's interested, that's very well represented in a 15-year interchange between two notable academics, Professor Stephen Bainbridge from UCLA and Lucian Bebchuk from Harvard. It really does do an excellent job of setting out the issues here. You know, effectively, I see this as a battle which is still very much engaged and very much at the centre of corporate governance and ethics. I guess there's two questions that arise. One is that the objective of the corporation is the centre of the corporate contract. Investors understood that objective function of boards was to maximise shareholder value. You know, has that changed? If so, in what way is it important to institutional investors? And secondly, the objective function sits at the core of ethics. You know, the ethical question is, what are the obligations of boards and managers on those other stakeholders? So hopefully that's the way I've said that it's meant to be a pretty parallel discussion with societal utility that I've already been through. Okay, so looking into that a little bit deeper, the difficult question, which is very difficult to resolve, is if a board or a management team or institutional investors are looking at the utility of a number of stakeholders, how are those individual utilities calculated and traded off? You know, that trade-off and that interpretation has major implications for the way that boards and managers make decisions and institutional investors. Where I think the rubber hits the road is where there are any implications or situations where that widened responsibility materially hurts shareholder value. And shareholder value in the long term, not in the concept of maximising short-term profits, but in the concept of maximising long-term shareholder value. I've been unable to identify any outcomes in New Zealand where that is the case. And more broadly, I've been able to identify any outcomes in the US, which seem more consistent with the business roundtable statement that's set out on the slide. I think it's a really critical question for corporate governance, because if the obligations of boards and institutional investors to other stakeholders, boards and to other stakeholders has material impacts on the corporate governance contract as it's presently negotiated. I think that has material impacts for the corporate governance contract, and I think it's something that both boards and institutional investors should be well aware of. So, trying to be a little bit more specific about that, if there is a transfer of value in that sense from shareholders to other stakeholders, you know, what are the implications of that? Firstly, I think you'd expect that to cause the cost of capital to increase and equity values to fall. Given that corporate governance is a contract between issuers and shareholders, changing that contract is going to have a material has the potential to have a material impact on the value of the securities. Secondly, will that have an effect on business focus? If there's an increased focus on other stakeholders at the expense of shareholders, what are the implications of that? Thirdly, in a little bit of a broader economic framework, if there's a move from economic efficiency, from maximising shareholder value to a broader stakeholder list, I think that's got material implications for economic efficiency. The last issue I'd like to really think about here a little bit and ask you to think about is given if this multi-stakeholder accountabilities are real, how are boards of directors of issuers going to be held accountable for the work that they do? It seems to me that's an extremely difficult exercise because it requires utility of different stakeholder groups to be assessed against each other, and more so, who's going to hold directors to account? You've got a number of stakeholders out there, all with different objectives, and they're all going to be interested in how the directors are exercising their responsibilities relative to their individual objective functions, if you like. And I just think it's incredibly difficult in that context for directors to be held to account at all. And this is one of the issues at the centre of the Babcock-Bainbridge discussion, and I think that the issues are very, very real and potentially of concern to institutional investors. So, you know, as an implication of that, I think there's the question to be asked to institutional investors is what obligations do they have as an actor in the corporate governance contract to ensure that the corporate governance contract remains fit for process, fit for purpose. And I think that the views of the shareholder primacy versus stakeholder primacy are a critical aspect of that. Secondly, and I'll need to increase my pace of delivery a little, the second issue is the importance of the II relationship with boards. And I thought I'd just briefly go through 4 quotes. Firstly, from Adam Smith in the 1770s, negligence and profusion must always prevail in the management of the affairs of joint stock companies. Burl and Means, who are one of the doyens of corporate governance academia, the separation of ownership and control is inevitable and destroys the very foundation on which the economic order over the last 3 centuries have rested. And then Lewis Gerstner, who is well known as their chairman and chief executive who turned around IBM in the 1990s, said effective corporate governance requires II involvement. The real mechanism for corporate governance is the active involvement of the owners. So the point I want to make strongly here is that for corporate governance to be effective, institutional investors need to act like owners. And I think the next couple of slides, I guess, implicitly asking the question about whether institutional investors are doing a good job of executing on those responsibilities. If institutional investors are going to act like owners, it seems to me the only way that can be effectively represented is if institutional investors have close relationships with boards and hold boards to account. What is it? I think there's 2 obligations here. Is just as a result of our fiduciary responsibilities, I think we've got an obligation to care about corporate outcomes. And if you believe Mr. Smith and Mr. Burl and Mr. Gerstner, and I guess my implication, I don't think that the corporate outcomes can be managed effectively and less institutional investors hold boards to account. And secondly, as elucidated in my discussion about society, I think there's a broader obligation for institutional investors to society to ensure that corporate outcomes work for society. And I think if we accept that obligation as institutional investors, the only way that we can effectively deliver on that is to hold boards to account for their performance. So, what does monitoring boards mean? What does monitoring boards mean? I think it means accepting our responsibility to ensure that boards are fit for purpose and exercising our governance assets to ensure that objective is met. So going down into a little more detail, diligently analysing resolutions and proxies, jointly establishing a relationship with boards to enable accountability. If you've got one party that's responsible for the behaviour of another, there's got to be a framework established. So institutional investors need to set a framework, issuers need to report against that framework, and then institutional investors need to monitor the performance of boards against that framework. Thirdly, I think institutional investors have got a responsibility to ensure that boards are fit for purpose. So they've got to adopt a major role in the appointment of directors and the balance of boards, and be active in those decisions. And lastly, I think that IIs have got a responsibility to ensure that boards have got the right skills. And I think to do that, we have to form a close relationship with boards and directors. We've got to establish a relationship that's close enough so that we can address the efficacy of directors and boards. I think if we can't meet a level of governance which reaches this level of accountability, I think we end up just replacing one unfettered agent, i.e. the manager, with another unfettered agent, the board. We have got an obligation, and I think for corporate governance to work effectively, we have got an obligation to society to hold boards to account, as I've described. So I'm going to skip over this very carefully because I am running short of time. But I think just summarising, if you like, the previous points that I've made, I think we do have an obligation to influence outcomes. And I think the reality is if directors aren't held accountable by boards, if directors and boards aren't held accountable by institutional investors, they aren't held accountable by any party. And to me, that's a dangerous sort of economic construct. And I think the responsibility that institutions have to meet that responsibility is critical. So I'd like to move on now to the third issue. So those first two issues were sort of discussing the corporate governance responsibility of institutional investors. Now I want to move a little bit on in 5 minutes to the responsibilities of IIs and the way that we behave in markets. And the first one I'd like to cover briefly is market conduct. One of the really pervasive themes in academic research on ethics is that there's a widening gulf between what is legal and what is ethical. And sorry, I've forgotten the name of the book, but there's a number of recent relatively popular books on the subject which address that. So the effective question here is obeying the law enough? Because I think the traditional representation or interpretation of investment markets by institutional investors is that we're almost in a zero-sum game, where it's the role of the investors to maximise returns, and any advantage that institutional investors take over other participants is fair game, to be colloquial. I guess the question I'm sort of asking is maybe to refer on the Research Foundation of CFA Institute publication from Marianne Jennings, who asked the question: something is ethical if I feel comfortable, if I were on the other side of the coin, and without making any judgments, I guess I'd ask the participants just to reflect on the most business as usual example. Just imagine that there's some information that's entered the market which has a clear value on a security, but the price of that security doesn't instantly react to the new information. Is it ethical for IIs to exploit the short-term information efficiency? Does it depend what that information is, how complex it is, how widely was it disseminated, how effectively it was disseminated? Does it depend on who the buyer is? Does it depend on what the security is? Does it depend on the risk to the informed buyer? I think all these are really interesting questions, and I've got a few other thoughts, but I won't address now. But I think just raising that question, and I guess also as IIs think about that question, what standard should we be applying? Should we be applying the standard of an unsophisticated investor, of the hypothetical reasonable man in law? I think it's some really interesting questions there about what's ethical behaviour in the market. And the last topic of conversation I'm going to address is capital raising in the New Zealand markets. It's interesting to me that even though best international corporate governance and the NZX code mandate the most effective way or the fairest way to conduct capital raising issues are pro forma rights issues, yet virtually all New Zealand issues are placements. And I guess there's a question I'm asking here about why that is and what the implications of that are. I think if you think about what a placement is, it's a financial transaction conducted by the board, which creates rights to buy shares at a discount to the current price, and then allocates those rights to a number of different parties. My challenge is that is it fair to allocate those rights to parties other than the existing shareholders of the issuer? And I think it's pretty clear that if those rights are allocated to other parties, that there will be winners and losers in that transaction. And effectively, the board or the advisor or the decision maker is effectively transferring value from one group of equity holders, one group of stakeholders to another. And I guess the big ethical question I'm raising is, is that fair? because I guess my view, having looked at the behaviour of the New Zealand market, it seems to me pretty clear that the winners in this process, and I won't go through the reasons why because I'm just running out of time, institutional investors and retail shareholders with strong links to broking firms, or retail investors who are very sophisticated. They're the winners in this process. So who are the losers? The losers are the shareholders without representation, index funds, international shareholders, shareholders who are financially constrained, shareholders who are uninformed, or shareholders who don't understand the process. So I guess I'm raising the question that, you know, if institutional investors are just maximising the value of the structure that's put in front of them, you know, their obligations are clear. They should support capital raising, which is a placement, and act to maximise value of their interests. But I guess the ethical question is, if this is a structure which is resulting in unfair outcomes, mainly to non-institutional investors, but sometimes to institutional investors, should institutional investors feel obliged to support that structure, or should they feel obliged to challenge that structure? Okay, lastly, as I said, I tried to avoid making a case here, but I've clearly made it. I think institutions have power. With power comes responsibility. I think that there's a real obligation, ethical obligation of institutional investors to meet those ethical responsibilities. And as I said at the beginning, this is a work in progress, and I welcome any feedback either now or one-on-one or by email. But again, apologies for trying to cover too much ground, but we are where we are.
Thank you, Guy. We do have one question that came in a bit ago, actually, but I was so intrigued by your presentation, I figured we'd save it to the end here. So the question is from Gopani, and that question is, being an institutional investor, what is the common mistake that you see institutional investors make, and how what they make, and how institutes has to come over, and what institutions need to do to correct those mistakes, I guess?
I think answering the questions in the context of governance, I think the biggest mistake is not being involved enough and active enough in the appointment and monitoring of boards. I think hopefully that's pretty consistent with the presentation. I just see that as a hugely impactful role, both on financial outcomes that institutional investors have when they invest in issuers, and if institutional investors accept this wider societal obligation, I think it's an even accelerated responsibility to be very active in the relationship between the institutional investors and the boards, because the reality is, if we don't do it, I don't think it gets done. And I think that's a major challenge to the corporate governance structure.
Okay, we got questions fast and furious now. Here's one from Anastasia, who asks, isn't the issue with relying on ethics that everyone's idea of what's right and what's wrong is different? Unlike codified laws, etc., ethics is not codified. How do we determine right and wrong? Interested in your thoughts.
Yeah, totally agree 100%. I think it's very well summarised to the point that I can't really add a lot. I guess the question I'm raising from a II perspective, is it enough to be legal, to obey the rules, or is there an additional ethical layer of responsibility that institutional investors should be accepting responsibility for? But I think it's a very good summary, and I agree 100% with it.
I guess on that point, if you look to a country that has gone to the extreme of codifying what ethics might look like, that would have to be the United States, which one could arguably say that the ethical behavior has had some low spots over the years, and in fact, codifying to the nth degree ethical behavior, doesn't that just keep lawyers and accountants employed?
I think that's a good summary. So yeah, my take from that would be, I don't think you can do it by rules. I think that the current, the current complexity of the markets we operate in, and more broadly the society we operate in, doesn't enable a rule-based structure to work. I think as agents, we've got to accept ethical responsibilities and execute on them. And
arguably, you could say that's the approach the Financial Markets Authority is taking, is well, they start at the top in terms of corporate governance, but not codifying, establishing a code of conduct that is generic and not prescriptive. So guys, we're just about out of time, but kind of a follow-up last question from me, backing the helicopter ride up and getting an overall view of the topic. I guess my question comes down to the guts of it. Can investors, stakeholders, shareholders do well by doing good? And that's the core part of the question, I guess, and that's the essence of ESG investing. So, you speak as if there's a friction between stakeholderism and shareholder value. Is that necessarily true? And I guess is not the premise of value creation through ESG investing, is that not incumbent on there being additional value created through stakeholderism? At least that would be my interpretation.
I think I probably need another hour and a half to address that issue, Jeff. I guess my insight would be, as the structures are currently defined, I don't think that I don't have confidence that that's the case. I don't have confidence that that stakeholderism, certainly as it is employed by some investment managers, will not have some impact on what I've called the broader corporate governance contract. I do see a conflict there. I guess if there's not a conflict, then we're back to my sort of scenario where effectively all stakeholderism is doing is focusing investors or the market on the implications of stakeholderism for long-term shareholder value. And I think that's the way that the market's interpreting stakeholderism at the moment, and even quite broadly right across the globe. And if that's true, we don't have a problem. But if we get to a place where stakeholderism materially threatens shareholder value, in other words, reallocates the value of the issuer that the shareholders have a right to, I think that's got many different implications. I guess as an example, just to reflect back on the Warren Sanders situation, if there was a decision made to effectively for issuers to give 20% of issue capital to employees, I don't think it's practical to assume that would have no impact on shareholder value. So I guess what I'm saying is there's a continualism, whereas I think if stakeholderism is applied with a strong orientation on longer term value, I think that can work quite well. But if there's a situation where stakeholderism means that there's a material transfer of value from, say, shareholders to employees, I think it's a very different story. And I think there's a real obligation, ethical obligation on institutional investors to understand that continuum and where we are on that continuum.
Well, thanks. I think I probably baited you a bit there, because what I heard you say is the question raised was really a topic that you're going to need at least another hour and a half. So that sounds to me like that's an invite to you to come back again to carry on with the topic, because certainly as charter holders, all ethical considerations are a topic of extreme interest to us. And I'd have to say, looking at the turnout today and the dropout, the fact that we're basically ending up the hour discussion where we started out, and I think says a lot to number one, your presentation, of course, but also the topic. Guy, thank you so much for your time today. I know you're very, very busy in your day job, but thank you so much for your contribution to the society as a charter holder. Appreciate it greatly. And the audience, thank you very much. Good turnout today, and we had some good questions come through. All in all, yet another successful webinar. So thank you, and of course, Kylie, our executive director, for organizing everything and making this the successful webinar series that it has become.